30 minutes till the start of the cash trade. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, a cosmic reward. Palantir's blockbuster results help reignite a rally in stocks.
And it's official. Elon Musk merges SpaceX and XAI in a deal that values the combo at $1.25 trillion.
That's even more cosmic. Big news from the House of Mouse. Disney names its next CEO.
Also cosmic? I don't know. I like that as an adjective. I'm into it. I'm just going to start calling every deal, every CEO announcement.
Get into it, yeah.
Yeah, I like it. Anyway, I've got to check on Disney shares this morning off the back of that announcement. They're up 1.25%. It tapped into something that we thought might be coming. They've tapped their Parks and Cruise unit head, Josh D'Amaro, as CEO, succeeding Bob Iger. D'Amaro, a 28-year-old veteran of the company, he will take over on March 18th.
Yeah, I'm looking forward to seeing what he can do there. Palantir, this has been an incredible story. Earnings and revenue forecasts significantly topped the already punchy expectations as it strengthens ties to the Trump administration to help carry out military and immigration efforts. You can see the shares already very highly valued indeed, up another 11% in today's trade, Dani.
Matt, let's start with those movers, and specifically Disney. Here to discuss is Bloomberg Tech's Ed Ludlow. I gotta say, Ed, the feeling of having the head of the parks now becoming the CEO makes Disney feel a little bit less techy these days.
Yeah, but the parks is so core to the bottom line. It's been a huge focus of Josh D'Amaro to embark on a $60 billion transformation. And one thing I'd say, just looking at the share reaction to this confirmation that Josh D'Amaro will succeed Bob Iger as CEO at Disney effective March 18th, 2026, it's not far away, is that Bloomberg reported this on February 1st. Right, and it seems that within those four internal candidates, Josh D'Amaro has been the board's front runner. And just looking at the language of the statement that the board put out, the decision was unanimous. And in it, Mr. James Gorman, chairman of the board of Disney, says that Josh D'Amaro possesses a rare combination of inspiring leadership and innovation. There's a lot of questions, right, about, well, what else apart from the parks? And so within that news is the item that Dana Wollman gets promoted essentially to be president and chief creative officer, but report into Josh D'Amaro, who also joins the board. And so the division of duties across parks and then entertainment streaming, that's going to be really interesting.
It's interesting because streaming is still growing faster than the parks business, right? I know the parks business makes up a massive chunk of profits, like 60%, but it won't be the biggest share of the money Disney makes for much longer. Yeah,
and I think about the environment that we're in right now with potentially Netflix, Warner Brothers Discovery, or Paramount Skydance, Warner Brothers Discovery. On the earnings call, you know, in the last 48 hours, a lot of that focus was Josh D'Amaro talking. But, you know, they are clearly conscious of what the changing landscape looks like. And, you know, back in 2020, when Mr. Chapek took on the role, had formerly been Parks chief, it was the same thing in that COVID era where there was a huge battle to gain streaming subscribers. So I'm very interested to hear Mr. Gorman's thoughts in 30 minutes' time about why Josh's background as the parks chief is the best for Disney in its entirety.
All right, looking forward to that interview. Ed Ludlow of Bloomberg Tech is going to speak with Disney's chairman, James Gorman, at the Open. So stay tuned with us at 9:30. That interview kicks off. Now, Palantir's revenue forecast for the year is $7.2 billion. And that tops Wall Street estimates by nearly $1 billion. Bloomberg Tech's Caroline Hyde is at the desk with us to talk about this big beat, really, for a company that's already very highly valued, but I guess showing its worth.
90 times future revenue is where it currently trades, more than 140 times future earnings. This is why you might see the odd price target actually getting pulled down by certain analysts today. But in general, a smashing beat. And actually, stock has been under pressure really leading into these numbers. So we did see a bounce in the pre-market. We're still currently trading high. We could wipe out a lot of this year's losses, which to the tune of 17% already year to date, and we've only just done January. But we had been questioning whether this was really the AI performer or whether it was getting getting mixed up in the rest of the software names, which have been performing dismally. But clearly, many analysts are thinking Palantir is just in its own league when it comes to actually understanding your data, using your data, and making sure that you can make the right decisions, whether it's commercially, where they've grown the business more than double in the previous quarter in the US, or whether it's from a government perspective, and more broadly, the United States, they're just seeing 90% growth. You can't question that for many, and no wonder we're therefore seeing a lot of analysts saying this looks pretty stellar all round.
By the way, I should point out that it was the CEO, Alex Karp, who described their revenue as a cosmic reward. It wasn't just Matt and I turning a new phrase.
He loves it gaming. Deng Xiaoping, I hope you're going to start citing his legacy as well, as that was also in the earnings.
I mean, Karp always has something colorful to say, but one of the things I was interested, he also went on to talk about, is that this is a company that does feel like it's facing some backlash for its involvement in the U.S. Government's immigration efforts. He said that they cast their software systems as capable of preventing an unconstitutional intrusion into the private lives of citizens by the state. How is Palantir handling some of the political baggage that might come with some of their work?
This political baggage has gone on for years, and he has always been saying that they very much deepen themselves within their moral code, that they feel as though they should be pushing forward Western ideals, and they will work with Western governments, and particularly the United States. Now, he says these sort of internal conversations aren't always easy, and there's a lot of debate, but particularly when it comes to their work with ICE. Look, they use a Palantir app called Elite at ICE at the moment, and that is a way of understanding who's overstayed their visas, what their addresses are, and no wonder that this is getting very politicized at this moment. There are a lot of internal conversations that they have to have with those that work with them, but thus far they have stayed steadfast to focusing on the government, and actually that's where their roots are. You know, this company wasn't Alex Karp's, but also with Peter Thiel, who has very close relationships with the US government, and we're seeing actually, of late, a huge sentiment shift. Think how Google's internal conversations have changed in recent years about serving different governments worldwide with their software. Palantir has been steadfast that they always will, and look at the amount of money that's been going into defense tech more broadly. But yes, this is particularly heated at this particular moment. No one really knows what they mean by saying capable of preventing an unconstitutional intrusion into private lives. We need more information about that.
That is for certain. Hey, Caroline, really looking forward to your show today. Caroline Hyde, who, of course, will be her and Ed Ludlow at 11 a.m. Lots of news to go through. By the way, another huge Bloomberg scoop confirmed now that SpaceX is taking over XAI to create a combined company valued at $1.25 trillion. Bloomberg's Lauren Grush broke the story with Ed Ludlow and joins us now. Lauren, first of all, amazing reporting. Now we have the confirmation. What are the details about why Elon Musk is bringing two of his companies together?
Yeah, so I really think that Elon was laying the groundwork for this late last year. And if there's anything I've learned in my time covering SpaceX is that this company and Elon move fast when they have an idea. So he's been talking very openly about this grand vision of putting data centers into space for doing complex computing for artificial intelligence. And so I think he's been really kind of setting the stage for this merger ever since then. And so the idea is that, you know, SpaceX will be the tool that creates these data centers, and then XAI will be the customer that then benefits from those data centers and the computations that they do.
So what's the point of this merger, if you will, Lauren? I hate that term historically, but I guess since it's all under Musk, we can say it's a tie-up. It's always exciting to hear Elon Musk forecast things that are going to happen in the next couple of years, and then they take 5 to 10. But what are those current forecasts?
Right. So as of now, there are still plans to IPO the entire company later this year. Obviously, we are keeping an eye on that, and it also remains to be seen. But I also want to say that a lot of this relies on some very ambitious technology that Elon has been proposing, right? These data centers in space, they sound very good. SpaceX recently filed an FCC application in order to launch 1 million satellites for that purpose. But again, that's a lot of satellites, and there's a lot of technology that they will need to mature in order for these things to actually be viable. So that's going to take some time. And Elon, has given a very rosy schedule for when those will be ready. Obviously, I would add a few years to that, if not more. And then, of course, a lot of this relies on their Starship vehicle being ready, and that vehicle is still under development and has some time to go through in order to be an operational launch system. So, but that's what Elon and SpaceX do. They set these very ambitious goals. Typically they meet them, but just not on the schedule that they normally set them for.
Yeah, that seems to be a very common theme among all of Elon Musk's businesses. Lauren, excellent reporting. We're looking forward to following this saga with you. Lauren Grush. And by the way, this will probably, just maybe, featured on tomorrow's debut of Bloomberg Deals.
That kicks off tomorrow?
It does. In case you haven't heard, we're going to be tracking all the major deals, the power players, the major moves, capital flows, shaping global markets. Catch it Wednesday, February 4th at 12 p.m. New York time, which, yes, is tomorrow.
I'm looking forward. I'll set my DVR and watch live.
I was going to say, Matt,
I'm going to do both.
You don't watch it live.
I want to just keep it. For posterity's sake, Dani, really looking forward to that deal show, and every week we'll get everything we need to know on M&A. Let's take a look at what's going on in futures right now. In terms of the stock market picture, S&P futures are up just 0.1% now. So not feeling the kind of momentum we saw a little bit earlier in the pre-market session. NASDAQ futures still at 0.4%. Let's get a look at some of the individual movers on our radar, starting with PayPal. Quarterly earnings disappointed, and the company says CEO Alex Chriss will be replaced by HP, Hewlett-Packard's current leader, Enrique Lores, in March.
That must hurt. Like, you're named as the CEO, and then the shares plunge 17.5%.
Yes.
Probably not fun. Not fun to be that
but
person.
But at least you're starting at a low level,
so
and you
good.
can outperform.
It's a really good point. Also, we heard from Pfizer. They had sales estimates that beat. Demand for older drugs is helping to offset gaps from its declining COVID shot and pill franchises. They are facing a patent cliff, though. Shares are falling 4.5% this morning.
Pepsi says it will cut prices for top brands like Lay's potato chips and Doritos corn chips by up to 15% in a bid to lift sales because I guess consumers said they're too expensive.
Yeah, just in time for the Super Bowl. Coming up, HSBC's Max Kettner is going to share details of their investor survey and explain why Kevin Warsh's nomination changes little, at least for now, for his equity outlook. That's coming up next. Stay with us.
Let's get to high interest now. Look at what's making headlines around the world. NASA is pushing the proposed launch date for its Artemis 2 lunar mission back to at least March. The move comes after engineers found a hydrogen leak during a major fueling test, with the delay allowing the agency to review data and conduct a second test. The mission aims to return astronauts to the vicinity of the moon for the first time since 1972. Data services stocks are falling after Anthropic released a new AI-powered tool for lawyers. Anthropic said the tool can automate legal work like contract reviewing, briefings, and templated responses. The move highlights broader concerns about threats posed by AI to businesses in the media and information industries, or rather maybe to the jobs in those industries. Gold and silver are rebounding after an historic collapse from all-time highs. Precious metals surged at the start of the year on speculative momentum and diversification needs, geopolitical uncertainty, and concern about Fed independence. The rally came to an abrupt halt last week after warnings that the advances had been too large and too swift. But we're seeing a little bit of a recovery now. Dani, I heard someone forecast on Bloomberg Radio this morning $5,500 an ounce again.
I guess if you loved gold at 5,000, you'd love it under 5,000. So why not buy the dip? Equities are rebounding alongside of it, but we have had days of volatility. There was the Fed chair pick, that metals boom and bust, concern over AI deals and overspending. Evercore's Julian Emanuel says that earnings are not a concern for the stock market.
It is an environment where we are in a state of unprecedented flux and change, geopolitical makeovers, but the abiding concept, when you look as an equity investor, is that earnings are really going strong.
Let's bring in HSBC's Chief Multi-Asset Strategist, Max Kettner. Max, always such a joy to see you. And I know that you've got a very constructive outlook for this year. I'm sure you agree with Mr. Emanuel that earnings look strong, but kind of these sideshows we're seeing, be it the politics, be it metals, be it elsewhere, do they have the potential to derail any rally we might get?
Maybe, over the very short term. So maybe that is the sort of stuff that keeps people on their toes over a day or two. But actually, when we look at it, not even over just 3 or 6 months, but even within a month, what it really does, those kind of sideshows, whether it's geopolitics or whether it's what we've just heard, this unprecedented flux, these daily ins and outs of politics, what it really does is it actually keeps positioning capped. So one of the concerns that we had at the start of this year was that sentiment and positioning in our framework got quite a bit stretched. So we did have at the start of this year, after the run-up in November and December, we did have a bit of a sell signal more broadly in terms of risk on and risk off. So for the likes of high yield equities and so on, we did start to get a sell signal. That has now all but disappeared in the wake of those geopolitical events around Venezuela and Greenland and Iran, and now obviously also those gold and Bitcoin sell-offs. So what it really does, it does help bringing down sentiment and positioning, and that, of course, over then a bit of a longer time period. I'm not saying a day or two, I'm just saying a month or 2 months, is really bullish, because what it does is it takes that excess positioning, it takes that froth away, and that opens up really the space to focus once again on what's important, on the earnings numbers, on the growth numbers, on the earnings revisions, the expectations, and those continue to be really strong.
Yeah, I note Nicole Inouye has a forecast for $300 on S&P earnings for 2026, which is not among the highest or even the median levels there. Is there, you think, room for that forecast to grow, Max, as well as the 7,500 year-end S&P target?
Yeah, look, I think I'm particularly bullish is now at the start of this year. When we look at the Q4 earnings season and the Q4 reporting season expectations, consensus expectations, we started with almost minus 1% quarter-over-quarter consensus expectations, right? Consensus was saying 8 of the 11 sectors are going to see earnings sequentially decline. Similar, actually, with Q1 earnings expectations. Where it starts to be, I think, a little bit difficult is towards the latter half of this year. When we look at Q3 and Q4, we're starting to see $82 and $84 of earnings expectations from 70 right now. So then I think the bar to beat in the third and the fourth quarter really gets a lot higher, in particular, given that right now there's all these stimulus hitting, right? We get the positive fiscal impulse now coming through with those capex incentives, the depreciation incentives, the tax reimbursements in February and April. That will probably change in the second half of the year, and maybe we're going to start really then looking into 2027 and maybe really start to see, hey, might there be some sort of negative, or at least a risk of a negative fiscal impulse? Perhaps if growth really is so strong, we're switching maybe towards pricing out those rate cuts from this year, maybe switching towards pricing a tail risk of the next move being up. And if that monetary and fiscal tailwind is being taken away and turns into a headwind, I think then it probably towards the second half of the year, it gets a little bit trickier, not only for US equities, but for risk assets overall.
We got a taste of that with Australia being one of the first major central banks to hike. Max, but when it comes to what's happening with fiscal stimulus, at what point in that even if that's a positive headwind for now, or become an issue? We see that happening in Germany. 30-year yields just hit their highest level since 2011 because of the spending happening in Europe. Japan, that's been a big concern. That's ruptured their bond market. Why don't we see something similar occurring in the United States?
Well, look, I think you've just mentioned Japan. When we look at Japan, I think that's a special case. When we look at the sell-off in the 30 and the 40-year, let's not forget that the ultra long end, so 40-year, for example, in Japan, is largely really dominated by domestic players, by things like the lifers. And the volume we had on this sell-off from literally 2 weeks ago was really driven by extremely low volumes, right? So we had about $250 million driving that JGB sell-off on the ultra long ends. I don't think we should extrapolate from that too much and take too many sort of global cross reads. That's number one. Number two is when you look at the US, actually foreign demand keeps growing, right? And we look at the foreign holdings, or the amount of foreign holdings of US Treasuries, they're still at an all-time high, and they keep going from an all-time high to another all-time high. So I think in terms of the demand, I think in the US that is slightly different to where we sit in Bunds or particularly in JGBs, where it's really driven by sort of domestic factors and domestic demand by those players, particularly the lifers.
All right, Max, great to have your take. Hope we can get you back soon. HSBC's Chief Multi-Asset Strategist Max Kettner joining us out of the London office. Coming up at the Open, Disney Chairman James Gorman discusses the company's new CEO pick. Ed Ludlow will come on Open Interest for that interview. This is Bloomberg.
A rally on our hands on this Tuesday, up 0.1% on S&P futures. Nasdaq outperforms thanks to Palantir earnings. Those are up 0.4%. Russell 2000 also doing well despite the fact bond yields are higher globally. Matt, what we got for single name movers?
Let's look at our single stock stories. Merck's sales forecast missed estimates due to challenges with its HPV vaccine, Gardasil. I wonder what those challenges were.
I'm not sure.
That's not something with which you want challenges.
No, you definitely. Any shot, but especially that, you do not want challenges. Then there's HP. Their board member, Bruce Broussard, has been appointed interim CEO of PayPal as Enrique Lores prepares to take, of HP. Enrique Lores prepares to take the helm at PayPal. So HP is falling because of that mix-up. PayPal is falling. Everybody is unpleased with their incoming CEOs or interim CEOs.
You know, HP is one more of those companies that's fallen victim to the idea of let's just do initials. Right? Because Hewlett-Packard was an internationally recognized name.
Yeah, you're so right. Hewlett-Packard sounds so much better than HP.
What if PayPal changed its name just to PP, you know?
For many reasons, they should not do that.
AMD reports earnings after the bell, with investors closely watching its push to compete with NVIDIA. And as a result, you can see AMD up 1.8%. We have less than 4 minutes until the opening bell. We're joined by Disney Chairman James Gorman next to talk about the new CEO. This is Bloomberg Open Interest. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are higher and indicating an open at about 7,000 right now, gaining, only 0.1%. Those gains are dissipating as we get closer to the bell. NASDAQ futures up a third at 25,933. There had been a gold and silver recovery that had fueled gains in the markets, as well as Palantir's knockout outlook. Oracle ringing the opening bell. The color red fitting for their background, as Oracle has been falling like a Led Zeppelin lately. Although, if you're an investor over a matter of years, it's done very well. I think tripled in the last 5 years. Pharvaris is a company that's going the other direction. Over the last 12-month period, this company is up 60%. And their clinical stage drug developer working on B2 receptor antagonists. I have no idea what that does.
I don't know. You sounded like you did.
Yeah, well, it affects the bradykinin protein level of cellular structure, so.
Is that real?
Yeah.
You just said, oh
I just used Ask B to find that out. On the Bloomberg terminal, you can type Ask B, and it's our own AI. So I said, what are B2 receptor antagonists?
Ask
and it told me.
Making you sound very smart. And you already are very smart, Matt.
Thanks
so adding
much.
a little bit of science credentials to that. I want to just point out what Palantir shares are doing, up 10%. Revenue and forecast significantly topped estimates. Its ties to the Trump administration also helping carry out military and immigration efforts. So, yeah, this is carrying the NASDAQ this morning, Matt. Palantir up almost 10% this morning.
Yeah, absolutely crushing it. Also, Disney has tapped Parks and Cruise Unit head Josh D'Amaro to be the new CEO, succeeding Bob Iger Part 2. Under D'Amaro, Disney has embarked on a $60 billion 10-year expansion of its resorts. He's a 28-year veteran of the company. He will take over on March 18th. And by the way, the parks and cruises, the experiences, makes up the lion's share of profits, even if entertainment still makes more of the revenue. Bob Iger is going to stay on the board and serve as a senior advisor until his retirement on December 31st. Speaking of the board, let's bring in the chairman of the Walt Disney Company, James Gorman, as well as Bloomberg's Ed Ludlow.
Welcome to our Bloomberg television and radio audiences around the world. After a 3-year search, Disney's board and its chairman, James Gorman, have named a CEO successor. Josh D'Amaro will be promoted from being Parks chief to succeed Bob Iger in March of this year. And Mr. Gorman joins us now. Good morning, Mr. Gorman. Thank you for your time. I mean, let's start with the simple question. Why James D'Amaro?
Well, it's Josh D'Amaro. But
Josh D'Amaro.
Good morning, Ed. He's a fantastic executive. He's strategic. He's run a huge operations, one which Disney is now investing $60 billion of capital into. He has great creative instincts. He has what Bob Iger calls exceptional taste. He's a leader who's operated all over the globe, including the recent expansion that's going to happen in the UAE, which he did with Bob. He's the person for this time. So Josh is just a standout executive. We looked all over the world, as you could imagine. We wanted to do this right. We wanted to make sure that whoever got the job beat all comers, and he beat all comers. So we're thrilled.
Mr. Gorman, what mandatory goals, performance targets did you set Mr. D'Amaro over the term of his contract?
Well, we haven't set goals in terms of his contract. He hasn't started. He'll be taking over as CEO at the annual meeting, which is March 18. Bob will be working with him through 2026, guiding and mentoring and helping further develop him. Obviously, he laid out a vision for the board in the various discussions we had, which we had numerous ones. We really got to know Josh and all the other top executives, Dana Walden, Alan Bergman, Jimmy Pitaro, just a tremendous group of 4 executives we had to consider in this process. And, you know, over time, we'll work with him as he settles into the job to lay out what the right strategic moves will be and how we're going to measure ourselves against those. So I'm highly confident in Josh and the team working with him.
Mr. Gorman, there was reporting that Mr. Iger confided in those close to him that he wanted to leave Disney before the end of his contracted term. To what extent did that push the board to move up its succession timeline?
Yeah, I think firstly, let's just talk about Bob. I mean, he's had effectively 2 careers at Disney. The first was an amazing 15-year run where he did deals that, you know, nobody else on the planet could have done, frankly. He worked with Steve Jobs, with George Lucas, with Rupert Murdoch to buy a bunch of studios, which we now oversee 7 studios, which Alan Bergman has been overseeing. By the way, produced under Alan's leadership and working with Dana, and has produced over $6 billion movies in the last 2 years. But Bob did a phenomenal job. When the company got in trouble, and it was before I joined the board, they invited Bob to come back. And really, there were 2 mandates for him. One was to get us through the very difficult post-COVID period and the changes taking place in the linear space with what was going on in streaming and now what is going on in AI. He did that. He really got the company fit for purpose. The second was to make sure if we were to go internal, that the lead executives, and we had 4 of them to consider, would be ready for prime time if and when we went in that direction. We ultimately did. So Bob came to us a little while ago and said, they're ready. I mean, Josh is ready. He's ready to take over. If the board's will is to move on this, I want to step aside and I want to work with Josh as a senior advisor, stay on the board through the end of the year. It's not about the length of the contract that he was under. It's about his role as CEO and then as mentor for the next CEO. So hats off to Bob. It was very selfless and frankly, it's what's great for the company.
Did you consider Bob Iger continuing on in a co-chairman capacity or a chairman emeritus type role? I appreciate that, you know, there is an advisor agreement here, but does that have a definitive end?
Yeah, Bob will stay as an employee advisor and board member until the end of 2026, and then he'll step off the board. He won't be an employee. He'll continue to consult to the company, consistent with what former executives do. I'm doing that at my former institution, Morgan Stanley. But no, we were not, you know, Bob was not interested in remaining as a chair or co-chair. We needed a completely clean start here, which is what we're having. He'll be there to support and mentor, and we have the right structure for the future. So we're thrilled. And, you know, you look at what's going on now that we've appointed Dana also as president and a new role, Chief Creative Officer. That's to ensure that the leadership team, at the heart of this company, is creativity and storytelling. And it's to ensure the leadership team brings their absolute best every day, leveraging our IP, telling stories across all of our properties, whether it's cruises or parks, our TV, our ESPN platform, and obviously the studios.
Right.
So we're really set. We're set for the next decade. I'm very excited about it.
Mr. Gorman, ultimately, you went with Josh D'Amaro for the CEO role. In promoting Dana Walden to the CCO president hybrid role, how conscious were you of keeping her, giving her that title to ensure she stays at Disney long term?
Oh, my goodness. If you don't want to keep talented executives, there's something wrong with you. We had an embarrassment of riches. We have, as I said, Jimmy Pitaro, who's run ESPN, is a fabulous executive. Alan Bergman, who's run our studios businesses at 7 studios, has done an unbelievable job. Dana, obviously, incredible executive with a long history in Hollywood, in the industry. And Josh, we want to keep all of them, and I believe we will. I mean, I think this is a win-win for everybody. And I couldn't be more excited about it. So yeah, absolutely. If you have talent, you want to keep them. Finding talent, developing talent is really hard. So when you got it, you do what you can to retain it.
Well, Mr. Gorman, it seemed like a 4-way playoff, right, of internal candidates. In that vein, how concerned or otherwise were you about keeping Jimmy Pitaro and Alan Bergman at Disney long term too?
Well, it was more than 4 ways. We really approached this, and when I say we, the board, we had a succession planning committee, and I was honoured to serve with Calvin McDonald, Sir Jeremy Darroch, and Mary Barra, who were the succession planning committee. Then we quickly moved to full board engagement, and each of the other directors played a meaningful role in this, and I couldn't be more grateful for what they did. But, we decided early on we wanted to look at all comers. We had a list, my goodness. It must have been over 100 people initially that we thought about, we considered, we evaluated. We ended up talking to several executives outside the company because I wanted to be sure, we all wanted to be sure that whoever got this job got it on their merits. They had beaten anything that was presented from the marketplace, and we had the best possible candidate. So that included external, it included internal, it included the 4 that you talked about. And I think all of them are very important to this company, and we're honoured to have them in critical roles.
Mr. Gorman, in May of 2019, I was sat opposite Bob Chapek at the opening of Star Wars Galaxy's Edge, right? And at that time, the parks chief, by February of the following year, he was CEO. And it was all about IP, his ability to take the growth in parks, the IP in parks, grow it out. Star Wars is a good case study. But to many, and maybe investors had a viewpoint on this, on a co-CEO structure or somebody coming from parks to lead the wider business. Josh D'Amaro has a very similar background to Mr. Chapek. How closely did you look at those parallels in that scenario?
Not especially. We look at the individual. We don't look at, just bios, whatever. I mean, you've got to look at what the individual has done. Josh is incredibly innovative. What he's done in the Imagineering space with those creative teams, building the IP into the parks, into the cruises. I mean, this is not an operations job. This is an operations and a creative job. It's telling stories that create incredible experiences for everybody who goes through those gates or gets on one of the ships. And he is incredibly capable at doing that. So I've always said what you look for in CEOs is not just what they've done, that's important, but it's what they're capable of doing. I tell the story, I ran Morgan Stanley for 14 years. I'd never been a trader. I'd never been a banker. You take people for what they can do, building on some of the things they've learned in the process. And I look at Josh as an individual, not as a comparison. And I think he'll be a fabulous CEO. He has all of the skills to lead Disney for the next 10 years.
Mr. Gorman, you were brought in as chairman in part to oversee this succession process. It's now over. You've reflected on your time at Morgan Stanley. What's next for you? Do you expect to remain longer term with Disney, or are you looking at perhaps a move back into the financial industry or something else?
Suggesting I retire, Ed?
Not at all, sir, but there is a great deal of interest in what you will do. Maybe you'll let us know.
No, I'm not. I mean, I work with General Atlantic, which is an amazing firm in the financial space, but I'm not interested in going back into the pure world of finance. I want to help the Walt Disney Company and help Josh and the new leadership team and work with Bob on this transition and help the board in making sure we deliver what we can. This company's trading at 15 times earnings. That's nuts. I mean, honestly, there are very few companies that have this quality of assets, this quality of bones, as I call it, than what we have. There are tremendous moats around the businesses. I'm excited about the prospect of what we can see from Disney over the next several years. So, no, I'm very much staying put. Thank you.
James Gorman, chairman of the Walt Disney Company, that today has announced Josh D'Amaro as the next CEO succeeding Bob Iger in March. Thank you very much.
Thanks so much. With you.
Ed, James Gorman, thank you so much for that fantastic conversation. The Walt Disney Company Chairman James Gorman. I should note, he mentioned his work with General Atlantic. Did you know I'm doing a new deal show? And next week we will be featuring the CEO of General Atlantic, Bill Ford.
I did know that your new deal show was in the planning, but I didn't realize it starts tomorrow. So it's so soon.
It's so soon.
And then a week from tomorrow, you will talk to the CEO of General Atlantic, which is great because James Gorman works there.
Yes, he has been advising them. James Gorman doing a lot of work. By the way, some breaking headlines we want to bring you. Walmart, which has had a huge run, has now joined the club of companies worth $1 trillion in market value for the first time. We were talking to Adina Friedman of the NASDAQ last week, Matt, who talks about Walmart joining the NASDAQ. Certainly their positioning is more techie has helped get them there.
Yeah, Walmart has had a real run of late. The company over the brief year-to-date period is up 13% over the last 12 months. It's up 27% if you reinvest those dividends, and it's pretty much tripled in the last 5 years. I think it's up 186% in 5 years.
Not too shabby.
Yeah.
Okay, coming up, we're going to talk about another company that is struggling, at least this morning, PayPal plunging following a CEO announcement, a profit mix. We're going to have more on that report coming up next on Bloomberg Open Interest. All right, a check on your equity market this morning. We're doing decently well, if we ever see it. We're up, I believe, like actually, we've taken some of the gains back. We're basically flat on the S&P. NASDAQ turns negative. It's down 0.2%. Russell 2000, a big outperformance, though, up 0.7%. Let's look at some of the top calls, the analyst action we are watching. First up, BNP Paribas. They downgrade Exxon Mobil to a rare underperform rating. They cite valuation concerns following the company's earnings report last week. Those shares, though, are up 1.4%. Citi, they upgrade JetBlue to neutral, seeing upside risk for the shares as the airline maintains strategic optionality. Shares are up almost 6.5%. Finally, Northland upgrades Palantir to outperform. They point to the company's, quote, extravagant fourth quarter results, something that Alex Karp called cosmic returns, cosmic performance, something cosmic.
Cosmic payback, maybe?
Yeah, yes.
I think his thing, cosmic reward. His
yes.
thing is that he wants to spite all the short sellers. Like his greatest enjoyment in life is retribution, which I appreciate. It's dramatic. I do want to point out, Dani, that
yes.
I believe we have achieved, at least on the S&P momentarily, a new intraday high, all-time high. So at one point, the S&P was as high as 69.93, and that is the highest that we've ever been.
Although get to 7,000.
Yeah, we're. Wait, did we make it to 7,000? We did. We did push through that at one point, didn't we?
Yes, last week.
Okay, so I'm wrong. Forget it. I'm looking at my HCPI.
I think it's on a closing basis,
function.
probably. That was a high.
It would be if we closed at that level. But yeah, you're right. 7,002 we achieved on January 28th. Forget I said that. PayPal posted profit and revenue that fell short of expectations. The company also announced that CEO Alex Chriss will be replaced by HP CEO Enrique Lores. Joining us now is Bloomberg's Paige Smith. She covers consumer finance. So it's interesting that the shares dropped 18% in the early session. Is this because they're concerned about Enrique Lores? Or, I mean, do they expect the new CEO to throw everything out?
Well, PayPal has had a really interesting story, I would say, over the last couple of years. I think analysts have really closely watched the company for indication of some kind of a turnaround, whether it's in branded checkout in particular. That's been that's been an area that has been very watched very closely. And, PayPal has made some progress in components of its business like Venmo and BNPL, or buy now, pay later options. But I think that as the CFO, now interim CEO, Jamie Miller, said this morning, she made it very clear that there was a timeline that just hadn't been met, and the CEO, Alex Chriss, essentially didn't execute in a timely manner, and that resulted in Jamie Miller taking over as interim CEO, and Enrique Lores, the HP CEO, will step into the role permanently.
What do we know about Enrique Lores? I realize PayPal also had poor results, but man, it just sucks. You're announced as CEO, and then you're like, shares are down 18% after that.
Significantly down, and I think that it is, we kind of joke that PayPal shares, you have to watch them very closely around earnings, because even if it seems like over the past few quarters there were instances where there were beats in core components of the business and shares plummeted soon after earnings were reported. But yes, Enrique Lores is coming over to PayPal from after a long run at HP, so we'll have to see how he fares. But I will say, our focus has been on PayPal primarily at the moment.
The stock, I don't know if we pulled up a 5-year chart. It's down 83% over the past 5 years, and it's no surprise. It's like the MySpace of payment methods, because obviously Venmo is first and foremost, but you've got new competitors like Apple Pay, you've got bank competitors like Zelle. There was a time when PayPal was inextricably linked to eBay, but that time is long gone. So what's their edge now? What's their unique selling point?
Well, so you did mention Venmo, and Venmo is a major business for PayPal, but I think you also hit on a point there that was, a lot of consumers know and love Venmo very well, but it is, it was a long period of time of Venmo just sort of sitting consistently and not really innovating significantly. And then, Alex Chriss stepped into the role a bit over 2 years ago and, really tried to lean in to monetize that business. And we have seen progress there. But kind of as you mentioned, there were, we have not seen the amount of growth, or rather the board certainly didn't see the amount of growth in PayPal branded checkout that was sort of like used to be the best known business of PayPal, and unfortunately that growth just hasn't been as significant as they wanted it.
I guess a long road ahead for the new CEO of PayPal. Paige, thank you so much for joining us. Paige Smith, there on the latest of PayPal as shares sink 18%. More on these markets coming up. You are watching Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what stocks are doing right now. Actually coming down on the S&P and on the NASDAQ after a morning of pre-market moves to the upside, driven by Palantir's gains after knockout outlook and a rebound in the metals trade. We're sliding lower again, 69.70 on the S&P after reaching 69.93 at one point on the upside. NVIDIA down 1 2/3% right now. Palantir still gaining 5%. Actually, Eric, swing back over here and look at gold, gaining 5 2/3% right now. Gold at 49.26. We are going to be coming back with a lot more news on these markets, a lot more news on the industry breakdown, as well as JPMorgan's Meera Pandit on AI disruption, Siemens Energy's CEO, and EQT's incoming chairman, along with Dan Zwirn. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. We were on our way to potentially reaching new highs. Now this equity market has turned around. We're down 1/3% on the S&P.
Even though Alex Karp got a cosmic reward. Palantir's blockbuster results helped reignite, or did help at one point, reignite a rally in stocks that has turned around.
Meanwhile, private capital's giant software bet has been upended by AI as private capital stocks take a hit. We're going to speak with a legend of the space, Dan Zwirn of Arena Investors.
And as power demand surges due to the aforementioned AI, Siemens Energy commits $1 billion to expand its footprint in these United States of America. We will talk with Christian Bruch in about 30 minutes' time. But we begin with stocks trading near all-time highs. Max Kettner of HSBC weighed in on his outlook for equities.
One of the concerns that we had at the start of this year was that sentiment and positioning in our framework got quite a bit stretched. So we did have at the start of this year, after the run-up in November and December, we did have a bit of a sell signal more broadly in terms of risk on and risk off. So for the likes of high yield equities and so on, we did start to get a sell signal. That has now all but disappeared.
Joining us now is Meera Pandit, JPMorgan Asset Management Global Market Strategist. Meera, it does seem like, since in the 30 minutes since we spoke with Max, people are kind of reassessing this. What do you think is going on here?
It was so easy to talk about the markets in 2023 and 2024. I long for those days. It was just Mag 7 and you hang up the phone. In 2025, things started to broaden out a little bit, where Mag 7 were still a big part of the story, but it was this broader AI theme around things like industrials, utilities, materials. But then you look at 2026, and it's been a pretty confusing year thus far. You see the best performing sectors are energy, materials, staples, industrials, while some of the darlings of last year, like financials and tech, are lagging behind. So I think about three themes right now. You have some of this geopolitical hedging. So that's where you're seeing in materials, particularly that rally around metals and mining linked to this metals mania. You have this cyclical rotation, and I would say that was a confluence of easing bias from a monetary perspective, some fiscal stimulus from the One Big Beautiful Bill, not only consumers in terms of higher tax refunds, but also some of the provisions for companies to spur on more CapEx, potentially help some free cash flow in the near term. And then you also just generally have this acceleration in an already reasonably hot economy. So I think about things like energy. The big story there is actually more around equipment, servicing, as opposed to oil itself. You look at, again, materials as one of those pieces there. Within industrials, you have construction, engineering, machinery. So it is this broader-based cyclicality you're seeing. And then within staples, you think about that lower-income consumer being held up by the One Big Beautiful Bill. So a couple of different cyclical pockets here. And then finally, that continued AI rotation from the Mag 7, the big tech players, to the everything else, where you look at the best 50 stocks so far this year, and 16 of them are tech, but then you have 12 between energy and materials, and another 11 or so within industrial. So again, that broadening out of that AI trade still happening within the market.
People have also loved to talk about that broadening out, about companies that are using AI that are more productive. But if you look through earnings reports, it's still very anecdotal. It's hard to find where it's actually showing up through the numbers, besides a few companies who have fired people and blamed AI, that they don't need to have as many employees. Are you a subscriber to that view that there will be companies around from, the infrastructure of AI or power, or the hyperscalers themselves, that will benefit from the technology?
You're going to continue to see, obviously, the core innovators benefit. I do think this infrastructure layer, where you're looking at companies within industrials, utilities, power, are also going to benefit. It just gets a lot harder to quantify as you move further away from that to the adopters. You are seeing, again, that anecdotally with certain stocks that have ripped because they're saying some of their AI-linked technology has really helped how they do their business. But, think about things like the internet. It's harder to quantify within earnings and how businesses run to say that is because of the internet, even though undoubtedly it's been such a huge productivity boost overall.
You are a global market strategist at JPMorgan, so it's not just about the U.S., even though often the U.S. is the hottest game in town. That wasn't the case last year, right? A lot of regional benchmarks outperformed the S&P by a lot. Was that just catch-up? Were they just playing catch-up because the U.S. had outperformed for so many years, or is that potentially something that we could see again this year?
There's some room to run in international, because what you see is international is really the only place where you're not seeing that rotation. You're seeing this rotation from large to small cap in the U.S., from growth to value, but you're not seeing that rotation from international back to the U.S. from last year's big run-up, where you had 10, 15, 20 percentage points in some regions. But if you look at what drove international last year, the dollar helped, low valuations helped, but but it was also these longer-term catalysts in different regions. Fiscal spending in areas like Europe and Japan, AI in China and other parts of North Asia. You're seeing that persistent in terms of really driving EM returns so far this year, particularly around areas like Taiwan and Korea. So you're certainly seeing some runway in a number of those themes that I don't think are going to end here in 2026, especially because the weakening in the dollar so far has helped. Of course, there's been some give back there. But I think for this year, we'll probably see an overall weaker dollar, which will wax and wane between slightly weak and much weaker, depending on the headlines.
Well, what is the sort of boundary of weaker dollar that's great for the multinationals? It's wonderful for stocks versus it represents some sort of, maybe a buyer's strike is a little extreme, but some sort of drift away from American assets that in turn is bad for American risk.
I think about how it seeps into other asset classes. Because what you saw in April of last year is, while we had a very sharp slide in the dollar, when you look back at the data, you didn't actually see en masse people selling treasuries from abroad or en masse people reducing their equity allocations in the U.S. from abroad. So I think that when you look at areas like the equity market that still look reasonably solid, and it's not like money's coming out, it's just rotating within, and then you look at treasuries where yields have gone up a little bit in recent days, but are not spiking, I still see that as a reasonably favorable environment for the U.S. asset base.
Beyond the AI issue, what do you see as the biggest risks? I mean, are you worried at all about inflation or the Fed? Are you worried at all about the Supreme Court on tariffs?
There are some upside surprises that actually could exist within that. If you think about the Supreme Court tariff case, if those are potentially struck down, then the administration could slow walk the implementation of new scaffolding around tariffs, and therefore that might mean a little bit less cost pressure to consumers. You could also potentially see, as we head into the midterms, if some of this fiscal stimulus from the One Big Beautiful Bill starts to fade and growth looks a little bit softer, maybe you do see another round of stimulus from the administration, which then helps to boost growth. But to your point, when we think about risks there, if growth is strong, it tends to bring inflation with it. So it is possible that we have another year where inflation doesn't head closer and closer to target. In fact, we expect that inflation will be around 3.5% by the mid-year because of some of these tariff and tax impacts. But it should fade away unless we do see some of these potential upside risks to growth that then also create some upside risks to inflation.
I mean, it's a very nuanced view of, yes, things are supportive, but so what advice are you giving clients of where to position themselves in this market to capture that upside and avoid some of the risks you're laying out?
There's still so many opportunities. Again, when you see this rotation within the equity market to some of the areas that do have lower valuations, that is a support, especially to international when we think about that global allocation. And then I think about the bond market, and we saw the MOVE index in terms of interest rate volatility elevated for about 4 years. And then in the last 6 months, it's really plummeted back to normal. So when we think about our bond allocations, if rate volatility is no longer a big factor and we're broadly trading in a range where the 10-year is somewhere between 4 and 4.5, then what we're really focused on is that income component, which has reset to a much higher level. So we're seeing opportunities in credit, in securitized, munis, some areas of the global bond market as well, given that dollar weakness. So you're really thinking about that income component in terms of a big generator. So you have both those opportunities on both the stock and bond side, and you broaden out to some of the alternative areas within the market as well in private markets. You're seeing some opportunities there as well.
Meera, so great to have you on. Thank you so much for joining us this morning. Meera Pandit of JPMorgan Asset Management. All right, about 40 minutes into your trading day, let's take a look at where we stand. Maybe something changed at 10 a.m., but all of a sudden, some pretty tough markets. Gold, sure, that's rebounding, but look at what's happening with the NASDAQ. That's down 1%, despite the fact Palantir had really strong earnings. That was lifting us up, but now it's NVIDIA, it's Broadcom, it's all of those tech heavyweights that are having a particularly difficult day, as well as the software stocks, Matt. It's a very nervy market around tech this morning.
Yeah, it's a tough one. NVIDIA being down 2.5% certainly doesn't help. Microsoft is off almost that much as well, and Broadcom down more at 3%. Plus, PayPal off 17% doesn't help. Let's get a look at some of the single stock stories. To the upside, Palantir's earnings and revenue forecasts significantly topped already punchy expectations, giving those shares a boost. They are currently up 6%.
Here's the one you mentioned, Matt. PayPal, they reported a disappointing fourth quarter result, and they announced that its CEO, Alex Christ, will be replaced by the current HP CEO, Enrique Lores.
Watching shares of Walmart after the retailer surpassed $1 trillion in market cap for the first time ever. You can see they are still up 1.25% at 125.57.
Coming up, we're going to be speaking with Dan Zwirn of Arena Investors as tech exposures concerns rattle credit markets, a conversation you don't want to miss. That's coming up after this break.
Let's get out of high interest. Look what's making headlines around the world. Disney is tapping Parks chief Josh D'Amaro to succeed Bob Iger as CEO, ending a 3-year-long search. D'Amaro is a 28-year veteran of the company. He will take over on March 18th. James Gorman, chairman of the Walt Disney Company, spoke here on Open Interest following the announcement.
He's a fantastic executive. He's strategic. He's run a huge operations, one which Disney is now investing $60 billion of capital into. He has great creative instincts. He has what Bob Iger calls exceptional taste. He's a leader who's operated all over the globe, including the recent expansion that's going to happen in the UAE, which he did with Bob. He's the person for this time.
Anthropic's move into AI-powered tools for lawyers is sinking data services stocks. Among the names getting hit, Experian and the London Stock Exchange Group. Anthropic said the tool can automate legal work like contract reviewing, briefings, and templated responses. So also bad for human employees. Blue Owl BDC is coming off its worst day since October 2022 after concerns over business development companies' widespread exposure to software sparked a renewed sell-off in the stocks. Fears of disruption have rattled credit globally, with software loans in the broadly syndicated market trading off around 4 points last week, Dani.
Let's get more on private credit more broadly. I'm pleased to say we're joined now by Dan Zwirn, founder, CEO, and CIO at Arena Investors, a global investment firm that manages $4.4 billion in assets. Dan, thank you so much for joining this morning.
Thanks for having me.
And what a time to come on. Look, I know BDCs have already been beaten up a lot last year and this year. Some of the software stuff is in there, but there continues to be this perpetual fear that's getting priced into them by public markets. Are they on to something? Do you think that fear is warranted?
I don't know. I think you have to be discerning. To paint them all with the same brush is more difficult. I would say generically, where there is opportunity for large-scale operators to deploy very, very large amounts of money, there's significant price competition. But if you look among the BDCs and you look at some of the folks who've been around a long, long time and who haven't really gone far up market, and you look at the underlying credit statistics of what they're investing in, they're pretty sound.
So what happened? We've had some blow-ups, right? And we have had fewer and fewer exits, certainly on the PE side. Was there just too money rushing at the same assets in a low interest rate environment, or what was the problem? Was there not enough due diligence? Did they not do their homework?
Well, I think there were two factors. One is that we've had the largest asset bubble that's ever been, and hasn't really been internalized by the market, that peaked in late 21. And what was different this time in a post-08 environment was that there's a tremendous latency between when problems happen and when they're kind of found out by the market. And so there's been incredible innovation, for better or worse, in terms of hiding those marks in various ways.
Hold to maturity.
Hold to maturity, or LMEs, or different forms of secondary transactions that allow people to kind of kick the bucket farther and farther and farther down the road. But at the same time, things like tech obviously blew up immediately, in 22, and you saw real problems in real estate in 23. And ultimately, the market is a weighing machine, and these things ultimately come out.
When do they come out? What does this actually look like? Because to your point, so a lot of these frothy deals done, in like 2021.
Right.
You'd assume you'd start to see more of it now, or is can kicking happen so much that this isn't a 26 problem, it's a 27 or 28 or further down the road?
Yeah, I think it's a kind of 27 to 32 problem, right? If you think about it as an example, leverage finance, you might not see secondary market bank debt trading down, but you will see that very same company is coming to us to factor their receivables or lease their equipment at very high rates, or potentially give up certain collateral that they otherwise wouldn't in order to kind of keep things going. And they alternatively might be part of a secondary transaction that allows it to kind of move along as well. So the balloon gets pushed and it kind of comes out in different ways that we haven't seen before, but it's there.
I was going to say, how widespread is that? Is that something you see commonly, that every day you have a company like this coming to you?
Yes, everywhere.
Across sectors too?
I would say certainly across corporate real estate and structured in different forms and different parts, and certainly across the U.S. and Europe, less so in APAC. But it's out there, and everything's on this slow roll.
So how many cases I'm fascinated by the secondaries, the rise in private market secondaries funds.
Right.
And because we've had a couple of shops on here that have raised, 10 or $20 billion for these kind of funds. Are there any examples that you look at and say, okay, that is a well-run fund, they have mature assets and they want, healthy liquidity to continue these because they're not ready for an exit or an IPO for one reason or another? Or are they all just sort of kicking the can?
I think there's three things going on. One is on the LP side where you buy LP interests. There are large numbers of large-scale allocators that need some level of liquidity. And the reality is if I buy XYZ Mega Fund 14 at 90 cents, I get to immediately write that up according to GAAP accounting, which makes absolutely no sense. And so that really kind of moves returns up and kind of creates more and more capital that wants to attract that. Number two is there are PE firms that have great companies, and why sell them? And if their investors will let them kind of keep rolling and keep growing them, great. It's a tremendous fee opportunity for the GP. They otherwise probably could have sold it strategically, but not the worst thing. And then there's the reasonable expectation that there's going to be a rationalization of the entire space. And there are a very, very great number, like thousands of GPs that aren't going to exist. And that starts to look like an NPL situation in a bank, where people say, well, I have these few assets, they're pretty good, no one really wants them, my investors are exhausted, and maybe I'll find these new guys at kind of a lower level so they can reset their promote, and it can still be one more shot for the GP to make a little money.
So it's definitely a reorganizing of the industry, and maybe if you want to put it nicely. But back when we were doing a lot of deals, part of it was a lot of money is coming in that needs to be invested. It feels like maybe we're entering something similar because a lot of retail cash is coming in. Do you think that there's immense pressures from ICs right now to get deals done? Are deals teams being overruled and maybe taking lower quality deals because capital needs to be put to work?
I think there's an element to that. I do think that we have to be careful when alternatives meet retail. And we've seen certain of these kind of retail-oriented, smaller level platforms kind of blow up. Ultimately, I think the right place for that is in things that are relatively homogeneous and understandable, like real estate loans, where it can kind of make sense, the customer knows what they're getting. The more esoteric you get, the more difficult it is, the more the missale might happen. And then you have problems down the road.
Where do you see the most problems down the road? Is it like tech exposure in BDCs or sponsor-owned portfolio companies, refinancing coming up over the next year or two?
It depends on where you are. So as an example, there's a tremendous opportunity coming for distressed investors in secondary market bank debt, right? The leverage finance world is kind of really overdone going back to late 21. A few years down the road, you're going to see distressed real estate in the U.S. be a very major thing because people bought and financed properties at really low cap rates with the expectation that rates would stay down forever. And then you're going to see a bunch of things within the structured finance universe, particularly in subprime land, where delinquencies are kind of moving up already, but the paper hasn't shown it, that are going to provide both securities opportunities and outright purchases of collateral.
What about where Matt started us off, software exposure? I mean, there are entire funds and their only business is software.
Yes.
Is that a problem?
We like to, as Buffett and Munger said, we don't like to pick winners, right? And people really bet the farm on the notion of software. And it's one thing where you have a significant margin of safety. So when we were making those loans in 2005 and the companies were being bought for 8 times cash flow, we were financing at 4 and making mid-teens, there was a lot of room for error. You come to late 21 and even past that, people were buying companies in the low 20s multiples or even no cash flow, right? And financing them to the low teens multiples. No margin of safety. When margins compress, when there's AI competition, the business may still have positive value, just not enough to kind of fill out that capital structure.
Dan, I mean, this is a lot of things to avoid. What do you like right now? Where are the opportunities in this market?
We like corporate lending in non-sponsor situations, in family-owned businesses, factoring, asset-based lending, growth capital, venture lending. Pipes in publicly traded companies where their kind of meme stock type of activity allows free convexity to be had. We like real estate and transitional commercial mortgage lending in the U.S. and also Northern Europe. And in structured finance, we like basically all the things that the banks used to do and now they don't, across commercial and consumer opportunities.
I think about the software conundrum a lot, as I'm sure you do as well. Because it seems like AI can do anything that I could program.
Yes.
So what's the big moat for a giant software company asking for a friend?
Well, I would argue that a lot of the software companies that we look at, certainly emerging software companies, their real big moat is the relationships they have with their customers. They're really locked in there, and they're effectively using the AI as a tool to make their customer experience better. So the question is, can they kind of get to the AI opportunity before it's taken away from them?
Dan, this was so excellent. Please come join us again soon.
Thank you.
Really enjoyed this conversation. Dan Zwirn of Arena Investors. Still ahead, the incoming chairman of the world's second biggest private equity firm, who I should note also recently did a secondaries deal. I'm sure Matt will have questions about that. And by the way, tomorrow we will be debuting Bloomberg Deals. So a lot to look forward to. This is Bloomberg.
Let's get a check on the stock market using the move screen. We are down right now, 0.6% on the S&P after futures were higher. And one thing I note that's very interesting is if you look at the winners here and take away Palantir, none of these companies are really tech. I mean, I know, we talk about Walmart being a tech company, but obviously it's not. If you look at the losers here, all of these companies are tech stocks, and they're big ones. So NVIDIA, Microsoft, Broadcom, Amazon, Micron, IBM, Meta, well, I guess S&P Global isn't. But the idea is that tech is really bringing us down, and you can see it here on the industry breakdown as well. When we come back, we're going to talk about the biggest non-U.S. private equity firm in the world. This is Bloomberg. Siemens Energy plans to invest $1 billion to ramp up manufacturing capacity right here in America in an effort to meet rising energy demands for AI data centers. And joining us now is Christian Bruch, the CEO of Siemens Energy. And what an exciting time to be in this industry. Tell us first about the business. Like, what are you building here, and how big is your order book?
I mean, as you said, it's an exciting time to be in the business. And obviously, you see electricity globally growing, but nowhere as big as in the US. And this is obviously why we expand our factories here, particularly related to the grids. I mean, everything which is like transformer, switch gear, so every component you need to transport electrons. And the other thing is on the gas turbine side. You see unprecedented demand, also driven by the data centers, obviously.
By the way, that's what I was talking about in terms of order books. Like, if I order gas turbines today, how long until I can take delivery? It's like getting a GT3.
One which is harder.
It's probably, I was about to say, right? You can probably get your GT3 first. No, I mean, we're sitting on 140 billion euros order book today. And if you talk about, let's say, large turbines, it brings you to the end of the decade, really, in terms of until you would get it off the factory. We're trying to really play the breadth of our portfolio. So sometimes we say, okay, take two smaller ones instead of one bigger one, and trying to be flexible. But very clearly, the market is as hot as not for a long time, so it will take you towards 29, 2030 really to see the slots. And this is why we try to find solutions to help our customers, despite that, to really make sure that we can power the data centers.
I'm always so fascinated the calculation it takes into deciding in these investments, because it's hot right now. What's it going to be in 5 years? Even hotter? Or are we going to have overbuilt? Are we going to go too far? How are you thinking about the balance between that?
That's a super question, I have to say. And this is obviously continuously the thing what I'm trying to balance. And we all have experienced overcapacity and how painful it is. And this is where we are very, very, very careful and looking at it. What we do at the moment is really investing a lot in our sites, which are existing today, and expand them. So that is effective capital spend, I would call it. But absolutely, I can see relatively good until 2030. I don't know thereafter what's going to be the situation. And the investments we are doing is also related, even if you just run a service business afterwards, which makes sense. We expand Tampa, Florida, which provides components for the gas turbines, which you also will use during the operations. So even if it's just a service business, you're still going to use that investment. So we're trying to balance it off, but it's not easy, particularly in a world where boundary conditions, geopolitics change continuously.
You know, on geopolitics, you mentioned, when I see an announcement like this, you're going to invest X amount of dollars in the U.S., I always think, at first, the company is trying to appease the administration, because surely President Trump is happy to hear that, right? This is what he's pushing for. On the other hand, you guys are out of Munich. BMW kind of pioneered the idea of manufacturing locally, where you're going to sell. It makes a lot of sense with the currency issues and everything. So how much of that is part of your decision, and how much of this is working with the Trump administration?
Look, first of all, I have to give the Trump administration the credit. They're very approachable. If you have anything in terms of discuss, how do we look on the market, what needs to be done, they're very approachable to us, and I appreciate that. But at the same time, we are investing here in the US because the market is extraordinary good, and we see it also from the long term, and the need is there, and AI going to be with us for the long term, right? In that regard, it's a decent investment, and this is why we do it. At the other side, I obviously look on it also to say, look, that's critical infrastructure, what we're doing. And there needs to be capabilities inside these countries to operate, build these critical infrastructure to a certain extent. So that's the largest energy market in the world. It was our biggest country in terms of order intake in 2025. So it makes a lot of sense. And I think keeping this balance, right, while you still need global interaction, global supply chain, right, makes absolutely sense for me. What will always be challenging to say I can do 100% in every country wherever I do business. This will not be the case. But the current push in terms of building further capabilities locally absolutely makes sense.
Can you get the expertise in terms of labor that you need here? Because in Germany, you have a strong culture of apprenticeship and a huge number of electromechanicers. I don't know how you say it in English, but studying to do the kind of stuff that you need done on a factory floor, whereas in the U.S., probably not as much.
Look, I mean, we have today 12,000 people in the U.S., right? And we put 1,500 on top of it. We know that we will also have to support the education training programs, and we're going to do it. This is what we are good at as a company. And we're building a training center, obviously, in Jackson, Mississippi. We're building a new training center in Charlotte, North Carolina, and to really make sure that this industry gets enough qualified workers. And that will be, let's say, a limitation going forward. This is why it's our job as a company to help to build this qualified, skilled labor. And this is what we're going to do. And this is why we communicated with these investments in parallel also education programs.
I know the U.S. administration has gone farther than just being supportive of energy projects. In some cases, it's outright partnerships. There was the recent one announced this year with Westinghouse, the nuclear power company. Have you been in talks with the government to go that step further, to do partnerships, get investments from the U.S. government?
You know, the energy industry is based on partnerships. You will not be able to solve the problems alone. And this is why we are very keen on partnerships, and either in the US or elsewhere, and we obviously are in close contact with the administration, because at the end it's not just the US, it's also where could we take partnerships, which we do here in the US, elsewhere, in other countries of the world. And yes, we are on this interaction. It's a continuous process, and I believe you're going to see going forward more partnerships to happen in that industry and also with us.
How has business back home? I mean, this is exciting to talk about your investment in the U.S. and the growth here we all see. But in Germany, there are some real problems. Electricity costs being chief among them, right?
Well, I would counter this a bit. I really have to say, right? Because I know that obviously if I also talk to our U.S. investors, they're very skeptical in terms of the current situation in Europe and in Germany. I have to say, it's much better than people perceive it sometimes. If I particularly look on the grid side, it has been the region which invested most in the grid in the last years. It's for us has been a very strong market. We are also investing into Europe and doing it at the same time. But Europe has a lot of homework to do. You need less bureaucracy. You need obviously more productivity on the sides. The good thing, I believe, is a lot of the things actually Europe can fix themselves if they get their act together. Energy is a hot topic, but you also have to see that the majority of the companies, take Germany, inside Germany, it's not energy intensive. It is a problem for the energy intensive industries, but it's much more important, I think, to get the labor productivity fixed and the flexibility in the market. That is something what a government really can work on. And in that regard, I'm much more positive on Europe than people sometimes perceive.
All right, Christian, been great having you in here. Hope we can get you back on the program soon. Christian Bruch there, the CEO of Siemens Energy. Let's get a check on what's going on in the equity indexes right now, as we saw drops and continue to see on the S&P 500, 69.35, the level there, after futures rose this morning on gains in Palantir, a positive outlook, and gains in gold and silver. We continue to see those gains. You can see gold at the bottom of the screen there, 49.17, up 5.5%. But the equity indexes are just falling as tech stocks stocks sink it.
Yeah, a really tough day for tech. We're also looking at some single stock movers in this hour. Oil stocks are one of them. The U.S. government is preparing to issue a general license that would allow companies to pump oil in Venezuela. It's part of the Trump administration's plans to ease sanctions and rebuild Venezuela's energy industry.
Pepsi says it will cut prices for top brands like its Lay's potato chips and Doritos by up to 15% in a bid to lift sales, maybe ahead of the Super Bowl.
And Pfizer releases data from one of its new obesity treatments with little detail, leaving investors wanting more. Shares down more than 3%.
We come back, we'll speak with the incoming chairman of EQT. It is the biggest non-U.S. Private equity firm in the world. This is Bloomberg Open Interest.
The world's second biggest private equity firm has had a busy year and a busy start to this year. Just over a week ago, it secured a landmark deal to buy pioneering secondaries fund Coller Capital. At the same time, it said it delivered its best exit year to date. Joining us, I'm pleased to say, is the incoming chairman of EQT and the current chair of Asia, John-Eric Salata. John, thank you so much for joining us this morning.
It's great to be here.
I got to say, I feel like there are a lot of announcements. So last year, a new CEO, he's been very vocal in expanding to the U.S. and investing more here. Your background is Asia, so you're bringing that in. A new secondaries fund. Do you kind of see yourself coming in as the incoming chair, as leading a transition, a transformation that's happening at EQT right now?
Yeah, well, it's a very exciting time for us at EQT. We are growing the business. We're already the largest firm outside of the United States, but we want to continue to diversify our business. What we see, we have an established business in private equity, in infrastructure, and in real estate. This addition of the Coller business, which is a secondaries business, is very complementary to what we do, and it's also one of the highest growing parts of our industry. Coller's business, their revenues grew by over 60% last year. It's a very high growth business, and by adding it to what we do, it's going to enable us to provide better solutions to our clients, and particularly now with our push into private wealth, which is a new initiative for us in the whole industry. This is something that appeals very much to private wealth clients and complements what we do on the private capital side.
So, and that's been very helpful to fundraising. Not just for you, but for other giants in the industry. How is the fundraising environment looking to you as we kick off 2026?
What's happening in our industry is the industry is really starting to consolidate, and there's a shift away from the tide rise, lifting all boats narrative, which was the case for industry over the past, say, 5 or 10 years, to one where investors are being a lot more selective now and are focusing on investment performance, focusing on distributions. How much capital are you getting back from your investors? We had a record year last year in distributions. We distributed $40 billion back to our investors, which is about almost 30% of NAV of the existing investments in our funds. We return almost a third of that back. So that sort of track record and distribution profile is causing investors to become a lot more focused. And if you look at the data in our industry, I think the top 10 firms last year in our industry accounted for more than 50% of all capital raising. So the industry consolidation trend, I think, will continue. I think you're also seeing LPs wanting to have fewer, larger relationships with clients because they're much more strategic. They have their own bandwidth constraints, and they want to focus on bigger relationships where they can also have more co-investment opportunities, which is also becoming increasingly important for clients.
And it comes after a period where it feels like anybody and everybody was starting a PE fund. I'd say it's a little bit unsatisfying because you hear these stories of not being able to fundraise, maybe people kind of like slowly winding down, just taking care of their portfolio companies. And I say it's unsatisfying because as a member of the media, you want to see like some big blow up, but it's just not happening.
Yeah.
So what does it actually look like out there?
We don't want to see that.
Yeah, to be clear, we don't want to see that, but it at least gives you a sense, a clear public sense of what's happening. So what does it actually look like? Are there a lot of smaller, mid-sized firms that are just kind of limping along right now?
There's something like 15,000 private equity firms in the world. And as I mentioned, 10 of them are raising more than half the capital. So there's, that shift towards consolidation is going to continue. There will be always room in our industry for entrepreneurial firms that are specialists in what they do, that are really good in a niche or in a geography or in a sector. But I think the industry is maturing, and with that maturation comes, for example, the advent of publicly traded private equity firms, which is our firm is publicly traded. Many of the leading firms are not publicly traded, and that gives firms the resources and the currency to expand and grow their business and develop their solutions that they offer their clients at a much larger scale. The other thing I would add is that what's happening now with AI globally and the amount of data that we need to look at is that the scale and the resources that you need to do that well, the bar is just getting higher and higher and higher. So I think the firms that are able to tap into that are going to have an advantage when it comes to the most important thing, which is delivering returns to clients.
So I'm fascinated by your vision in the long term, right? I was looking at your returns versus like KKR and Blackstone, and the further out I go, the better you do versus them. And you've said also it's not about 5 years or 10 years. This is about the long term, right? So where do you see, for example, regionally, you're pushing now into Asia. More people are looking overseas, even though the U.S. has historically been the only game in town. Like, where do you see EQT in the long term?
Yeah, one of the trends we're seeing with our clients right now is that our clients are discussing with us the need to get more exposed globally to the asset class outside the U.S. Not to say that the U.S. is not a very important part of the business. It's going to continue to be a very important, probably the most important part of our asset class globally. But Europe and Asia are becoming increasingly important, and investors want to be diversified. In this environment that we're in, diversification is something that people feel comfortable or want to have more comfort in having more exposure to, because of the uncertainties in the world and because of the different growth profiles that we're seeing.
But is that for good? Is that going to stick past the Trump administration and into whatever comes, if we ever have anything after that?
Well, for a while, the S&P 500 has been doing so well, it was hard to beat that. But if you look last year, the #1 performing stock market in the world was actually Korea. It was up something like 70%. And so getting exposure to Asia, getting exposure to some of these long-term thematics globally is important to investors, particularly investors that are investing for the long term, pension funds, family offices, intergenerational wealth management firms, and families that are trying to get that sort of exposure.
So you're expanding internationally. You've brought on secondaries. Are there any other gaps in EQT you see as you come into the helm that you'd be wanting to expand?
We want to continue to grow organically in these businesses that we're in right now. We're going to continue to look at opportunities to grow through expansion into adjacent areas. We don't have a credit business at the moment. I think that's something that we're comfortable not being a part of at the moment, but it's something we keep an open mind about. What's interesting about the Coller investment is that they have a growing credit secondaries business, which we think is an interesting way to get exposure to the asset class. They also have a very interesting opportunity to develop secondaries in infrastructure and real estate, where we have a business. And then, there's a lot of innovation happening in our industry around different types of vehicles, like open-ended vehicles, evergreen vehicles, structures like, for example, we have a very large data center business called EdgeConneX. It's one of the largest data center businesses in the world, over 80 data centers globally. That's a business that could easily be housed inside an open-ended type structure that people could get exposure to long-term, rather than a closed-end fund where you have drawdown structures that you have to eventually sell the asset. I think our industry is moving to a point where people are going to be able to and want to hold on to assets much longer to continue to get exposure.
Because we had someone on earlier who was like, not specifically talking about you, to be very clear, but was like, the advent of evergreen funds and secondaries, whatever, it's just can kicking. What do you say to that sort of posture?
I have a very different view on that. I think that, compounding, I think it was described by Einstein as the eighth wonder of the world. And if you can continue to own an asset that's compounding in value, why would you sell that? Why would you want to be forced to sell that after 5 or 6 years when you think it can continue to compound in value? So the question is, how can you meet the needs of investors that want their money back in 4 or 5 years, but also how can you create products and solutions for investors that are happy to hold on to assets that are going to compound in value for 10 or 15 or 20 years? And I think that's where the industry is heading. I don't think this kicking the can down the road narrative, it may apply in specific cases, but generally speaking, investors are quite discerning. Investors are not going to invest in companies or structures that have assets that are not strong assets. And generally what we see is that only the very best assets get put into these long-term structures, because those are the assets that investors want to get exposure to.
Can I ask, because we have more CEOs watching Bloomberg than any other network, and they look to someone like you who has succeeded in this way for advice. And I think particularly your story is interesting because you've had a very difficult time in your first expansion into Asia. Kathy Chan wrote a great feature on you last year. Yeah. How did you deal with the losses you experienced in your first go-round? And get back up, raise money again, and move forward?
Yeah. Well, I think Kathy made an interesting comment. She repeated the anecdote I told her that my password on my computer was the word perseverance, which I kept typing in every day for about 3 years. Those are the days before you had to change your password every few months. I think my own personal experience is that you learn a lot more from your mistakes than you learn from your successes. And if you're able to get through those, if they don't define you, then, and if you have great people around you and you're able to openly discuss and become sort of a learning organization that's agile and where you take those lessons on board, then I think you can continue to evolve. And the one thing about our industry is that it's continuously developing and adapting. Right now we have AI coming in industry. So your ability to adapt, your ability to sort of take in new ideas and learn from mistakes and have great people around you to develop the future growth trajectory of the firm is what really, I think, defines the firms that are able to succeed and navigate all the volatility in our industry.
Just be clear, you have changed your password, or else everybody else is about to try to log on to your email with perseverance as the password.
We have great cybersecurity now at EQT, so I've had to change it. But I come up with synonyms for perseverance all the time.
Maybe you shouldn't say that either, John. We're going to have to leave it there. Thank you so much for joining us. This was such a pleasure. John-Eric Salata of EQT. By the way, don't miss the debut of Bloomberg Deals tomorrow. We're going to be tracking all the power players, major moves, and capital flows shaping global markets. Hopefully John will join the show when he gets a chance. It's going to be every Wednesday. It launches tomorrow, February 4th at 12 p.m. New York. This is Bloomberg.
Builders are working on a plan for a massive program to develop Trump homes. The plan would tackle the affordability crisis while allowing private capital to deploy many billions of dollars. Lennar is among the firms that have worked on the proposal, and Bloomberg Intelligence U.S. home building analyst Drew Redding joins us now. So, Drew, this is a fascinating piece of news. My first thought is 1 million homes sounds like a ton, but I have no idea in the broader scheme of things how many homes we need in this country. What's the supply imbalance look like?
Yeah, so there's estimates that there's a supply shortage in the U.S. housing market, anywhere from 1 to 4 million units, depending on what math you're looking at. But I think it's more nuanced than that. I think the issue on the supply side is really that there's not enough of for sale housing at the lower end of the market for entry-level home buyers to come in, which is what this solution looks to address.
This solution, it's something that many cities, governments, whatever, have tried to tackle, Drew, and have really struggled to do so. How much of a step in the right direction is this?
Well, yeah, it's a good point. And look, to your point, a lot of, housing decisions are made at the state and local level. So it's always been difficult for the federal government to kind of reach their hand in and make any meaningful changes. I think what's important to take a step back first and realize that this is something that is being proposed by the larger home builders. You mentioned Lennar, also Taylor Morrison. So, as far as we know, it's not necessarily something that the administration is looking at. Now, it is good to see that we do have some proposals on the supply side targeted at the entry level where we mentioned the supply shortage is the most severe. And so what this ultimately ends up being is a federally backed rent to own program where, builders would construct entry level homes and buyers would rent for a period of, 2 to 3 years and apply some of that principal towards the mortgage. Now, in terms of the federal government's role, you'd likely need to see them design some kind of regulatory framework around this. They'd also need to be involved in the liquidity, and you probably also need to see them provide some zoning and regulatory relief.
All right, Drew, great having you on the program. Thanks for joining us such short notice on this breaking news. Drew Redding there of Bloomberg Intelligence. This is Bloomberg.